Welcome to Bull Compass.
How do you know when a trend has ended? To be successful in the market, it is important to know how to identify the end of a trend. If you hold on to a position for too long, you might end up giving back profits, or even worse, holding a position from profit to loss. And trust me, I've been there. The time when I felt most stressful when trading and investing was watching my position go from a 200% profit to a 50% loss. Doing something like that will make you feel like a fool. Nothing goes up forever, and as the saying goes, the trend is your friend until it is not. So how can we stay on the right side of the market? How do we know when a market has reached its peak and it's time to get out with our profits? Stick till the end of the video. I will show you how to identify the end of a trend, and as a bonus, I will show you some of my most embarrassing mistakes where I held a position for far too long. There are two textbook methods that define the start and end of a trend. Firstly, we look at the peaks and troughs on the chart. Secondly, we identify periods of market blowoffs and climatic selling. These two methods might be simple, but they have withstood the test of time. Looking at peaks and troughs is a beginner-friendly strategy. The market doesn't move in a straight line, but zigzag its way towards a direction. The direction of the peaks and bottom will determine if it is trending up, down, or sideways. In an uptrend, you will see a successive series of peaks and bottoms. To determine if the market is still trending upwards, we have to ask ourselves two questions. Firstly, was the market able to make new highs? Second, did a pullback bring price below the previous high? In theory, an uptrend is defined as a series of higher peaks and troughs. Price should be seen surging and making new highs as optimism permeates through the market. If price fails to make a new high, a resistance level is formed at the top of the current peak. This suggests that for the time being, there is not enough buying demand to drive the price upwards. However, this is not a reason to panic sell or enter short. Like we have covered earlier, markets move in a zigzag manner. The market could be consolidating before continuing on its original trend. Failing to make new highs is a sign of weakness, not trend reversal. If you're looking to enter short, it might be wise to wait for confirmation. And if you have ridden the trend all the way up, this might be the time to start being cautious. However, if a retracement breaks through a previous bottom, it might be a good idea to start taking profits, because the market making lower lows and lower highs is a definition of a downtrend. The real conundrum here is exiting at the highest price possible. It's just a matter of fact that markets are chaotic. Just as you start taking profits, the market could go higher before resuming its downtrend. But what's the alternative? Holding a position for profit to loss? Take this trade for example, where I held a position from a 200% profit to an 80% loss. From my experience trading, there is always another opportunity. Capital, on the other hand, is limited. We have to respect our capital, and no one ever got poorer by taking profits. Market blowoffs is very evident on charts. After a long advance, you will see a large surge in price on high volume. This is then accompanied by a sharp retracement, which results in a peak. I don't know about you, but when I was a beginner, I was obsessed with capturing profits at the top of the trend. My greed always got the better of me, and I always end up giving back way more to the market, as I was unwilling to sell until price went back up to those highs. The consequence of my greed was watching my portfolio slowly wither and die while I was waiting for a moment in time that has already passed. I believe we have all experienced the pain of leaving profits on the table, but this is, in my opinion, the result of having a scarcity mindset. There will always be another market to trade. Now, a selling climax occurs during a downtrend. This is a good example of a selling climax where the market has reached extreme pessimism. There was a sudden drop in price on heavy volume, a sign of panic selling. This is then followed by a quick rebound. Watching peaks and troughs and identifying market climaxes are two common ways to identify the current trend. However, by the time the trend becomes evident, a sizable chunk of profits have already been left on the table. You are neither buying at the lowest range or selling at the highest peak. To maximize profits and develop edge, you need to set strategic price targets. These can come in the form of candlestick patterns, trend-following indicators such as the EMA, or oscillators such as momentum. These are subjects that require an entire video on their own. So subscribe to this channel to learn how you can implement these techniques to tighten up your trade and investment plans. Before we end this video, let's go through a summary. An uptrend is defined as a series of higher peaks and higher troughs. A downtrend is defined as a series of lower peaks and lower troughs. Market blowoff is described as having a large spike in price with heavy volume after a long market advance, followed by a sharp retracement. Selling climax is described as having a sudden drop in price with heavy volume, followed by a quick rebound. That's all for now. I hope this video is able to shed some light on how to identify when a trend has ended. Of course, there's much more to trading than just understanding trends. So subscribe to this channel to get the latest videos. Like this video if you found it helpful, and if you have any questions, please leave them in the comment section below. Take care.